heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we'll take the pulse of the market and get a read on appetite of those magnificent seven as one name struggles to keep up with the pack.
And Snap joining the chorus of technology companies announcing job cuts with plans to slash 10% of its global workforce. Details ahead.
Plus, we'll get a check-in on the state of the semiconductor industry as global chip sales, they're projected to hit a record this year. The CEOs of onsemi and Element Solutions join the program. But first, let's check in on these markets. And it's a day of macro affecting some of the individual names at the moment. The market takes a turn as once again we're running too hot. The ISM number really coming in strong, services going well, and indeed the cost of services employment as well. What does this all mean in terms of overall inflationary pressure? We know that, of course, joining CBS over the weekend was one Fed Chair Powell, and he was talking back against any sort of rate cuts coming as soon as March. Add in that overall strong economic data, and we turn on the Nasdaq off by 0.8%. Interesting volatile play going over in China. Remember, as the S&P hit a record on Friday, we actually saw a 5-year low for Chinese stocks, and all of this as we see once again China trying to curtail any selling coming and indeed betting against the market over there and trying to push back against that volatility. We're off about 10% in terms of the overall Chinese names traded here in the US. 10-year yield, it crushes ever higher, up 15 basis points. This as we, of course, get that strong economic data and the read across to the Fed. Move on and have a look at what's happening in the world of crypto, though, for a moment, Ed, because, look, as we see a strong dollar, so Bitcoin goes a little bit lower, off by 0.4%, but still trading above $42,000. What have you got on the individual names?
Well, one name where there is still some buoyancy is Nvidia. Even when the market turned post-ISM, Nvidia is still up almost 3% and is extending those record highs that it hit. Goldman boosting its price target on the stock to $800 a share. And they're basically saying, we look at what's to come in the year, and we still think that there's going to be spending by the hyperscalers and in the cloud context. So that name continues to charge higher, fresh record highs. And it's just become this juggernaut. We're going to dig a bit deeper later in the show, Cara, of course, about the outlook overall for this industry in 2024, but AI still calls that story. A mover to the downside or in a different direction is Snap. This is interesting. The company is going to trim 10% of its global workforce. Later in the program, we'll speak to Bloomberg Intelligence's Mandeep Singh and kind of get a gauge on what's going on. When the headlines first crossed, there was kind of a spike on the shares in pre-market, but we are firmly lower now, down 3.9%.
Yeah, that's notable, isn't it, considering the read across from Meta and just the phenomenal move we saw in that company's shares after its earnings on Friday. And let's just talk more broadly about what's happening with big tech, with those magnificent seven names, and ultimately the read across from bond yields to tech stocks. Bloomberg's Isabel Lee is here with actually a great story talking, I love the headline, Elon just lost his cage fight with Zuckerberg. This was all about how ultimately Tesla's market cap has really diverged from that of, say, a Meta, which has just been on the up and up, particularly post its numbers. Friday, tech managed to outperform despite bond yields going higher. Not the same today.
It's not the same today, and the unusualness was highlighted indeed Friday because bond yields surged thanks to a strong jobs report. What happened to tech shares? They also surged. And usually this doesn't really go hand in hand because history would tell us that higher long-term yields aren't really they're particularly harmful to companies that are longer duration, which are tech shares, because they most of their values they put into the future. So usually when bond yields surge, tech shares are down, basically. But we didn't see that on Friday and in the past weeks, and this is why Bank of America's Michael Hartnett is saying that this is reminiscent to the dot-com bubble that he's seen, the rush into tech stocks, the irrational exuberance. And one can't really make sense of it. Like, why is it like this? On one hand, maybe because AI is just a contained situation on its own, and maybe those tech stocks aren't moving in conjunction with markets, but for the most part, a lot of unusual things are happening.
You know, the comparison that the article puts in front of us is whether Tesla should be magnificent or if it's less than magnificent. The number I look at is EPS growth, right? Because if you look at the 6x Tesla, we saw really big year-on-year EPS growth. In Meta's case, like more than 200%. Tesla was the exception to that rule. It saw its EPS drop 40% year-on-year. Both were having interesting comps with an interesting period 12 months ago. What is the case for Tesla being not magnificent to your mind, Isabel?
There is a lot of cases being Tesla not being magnificent, but there is also a lot of cases about how this whole sector should be even seen or grouped. Magnificent 7, Super 7, Elite 7, because if you look at it, the Magnificent 7 companies carry a 33% premium to the index when it comes to forward PE earnings. But then, should they even be looked at as Magnificent 7 as a whole? We know that last year, this Super 7, Elite 7 powered the NASDAQ index 54% higher. And those gains, some of them, really trickled into the new year. But last week we saw a divergence. When we have Meta and Amazon reported, they really had historic days. Meta saw $190 billion in one day, which is the most that we've seen in the history of U.S. stocks. But we have some like Microsoft and Apple. Yes, they beat, mind you, but then we saw shares fall because people were just really more optimistic. People had more lofty ambitions for those AI shares. So maybe people are now being more discerning. If you look at Magnificent 7 as a whole, they are big. Here's a random tidbit for you. It was in the article. The Magnificent 7 as a whole are worth more than the combined GDP of New York, Tokyo, LA, London, Paris, Seoul, Chicago, San Francisco, Osaka, and Shanghai. So they're really huge. But then maybe we should stop seeing or looking at them as one whole group now, Ed.
It's an interesting if you start thinking about the words concentration and risk. Bloomberg's Isabel Lee, just fantastic data analysis. Thank you. Let's keep the conversation going about the technology sector with Lisa Erickson, Head of Public Markets Group at US Bank Wealth Management. And I think we also better address what's happening in the moment. So when ISM numbers hit, the market turned. We're now significantly lower on the NASDAQ 100, about 1%. But if you drill into the data, basically the concern is the prices paid on materials and the idea that the Fed still has some way to go to fight inflation. Put that into context for us of the technology sector.
Well, certainly we've had a couple of strong prints with the non-farm payrolls report on Friday, and then again, to your point, a better than expected ISM number this morning. And really, I think what's going on with the market with respect to how that impacts overall equity pricing and technology in particular is that investors are simply concerned again that these positive rate cut expectations that they've had on the Fed really may need to be ratcheted down. We certainly saw that Friday. We saw it again this morning. And investors are just simply concerned that if rates don't come down as quickly as they think they could, again, that could impact, per Isabel's point, really these technology sector valuations because most of their growth is further out in the future. And to the extent that rates provide more competition, that just makes it tougher.
Lisa, though, what's managed to ultimately send these companies higher has been the distinguishing factor of artificial intelligence, being able to be that silver lining amid the cloud that is the macroeconomy, higher rates, concerns about jobs. Can AI still manage to lift these boats despite their valuations already being toppy?
We certainly see that long-term case for AI. Obviously, we're very early in the cycle, and we are seeing, for example, even in the near term, that continuing to bolster some of these earnings reports, whether it's on data center spending or whether it's on continued investment into cloud services. However, to your point, that doesn't necessarily mean that the road is going to be smooth going into the full year. And that is because we have had quite a bit of run up on that AI. And so I think some of that uneven response that you've seen to the earnings reports here with the fourth quarter reports is reflective of the fact that some of that optimism has already been priced into the shares.
The context also being that these companies are winning the rewards of investors, particularly if you take like a Meta, because of the cost discipline at the same time as they've been talking up their AI bets. And when you look at Snap today, yet more job cuts to come, how much do you think the overall macroeconomy can continue to see strong jobs where we do see companies taking this sort of disciplinary action?
Well, certainly we have seen a very strong jobs market, and there were a number of prints last week that really reinforced that message, whether it was from the non-farm payrolls report or the JOLTS or the employment cost index. As far as its ability to sustain, one really interesting fact is that many of those job gains are and openings continue to remain in companies with less than 1,000 employees, so those mid and smaller sized companies. And again, we saw that reinforced in the JOLTS data last week. And so with that, even though we may be seeing some layoff notices from those larger companies, the ability of those smaller end of the companies to continue to post job gains as they continue to make up for less hiring than they would have liked to in the last couple of years is still a possibility.
Before we called that group magnificent, we would basically say they have strong balance sheets, entrenched market positions, and if there's going to be a recession, that's a great place to be because they'll be fine. But now the conversation's changed from hard landing, soft landing to no landing. And I just wonder how you think about those names and some of the factors Caroline was talking about in the context of whether we actually just don't have any pullback in the economy at all.
Well, we're really looking at more of a balanced view right now on the U.S. stock market and the economy. And the reason why is that while, again, the economic data and the jobs market, to your point, has been better than most people have expected, we still have a number of cautionary forces in place balancing some of those positive factors. And so we have had really the most rapid rate increases in quite some time. And to your point earlier, really the inflation fight is not quite done, just as we saw, for example, with some of the ISM numbers this morning. And so with that more balanced view of rewards and risk, we really continue to watch where that landing will go, whether it's no, soft, or hard. And in the meantime, we're really just cautioning our investors to stay at whatever their strategic weights would be in the equity asset class, again, reflective of a more balanced reward-risk ratio.
Lisa, it's so great to catch up with you. Thank you for bringing your tech focus to the broader macro markets at the moment. Lisa Erickson, Head of Public Markets Group over at the US Bank Wealth Management.
The Semiconductor Industry Association is forecasting the global chip industry will see sales jump to a record level this year, fueled by a greater need for the electrical components from a broad range of businesses. Joining me to break down the data, Bloomberg's Ian King here in SF. What took me by surprise about this report is I get the overall 2024 is going to be good because 2023 was very bad. But it's not just one single thing. They're not saying it's AI and everything. They're saying across a lot of end markets, things are looking pretty good.
Well, you've got to remember that this is a projection by the industry association, right? Their basic thesis is chips are everywhere. And that is broadly true. More things need semiconductors. But we're also, as we'll find out in a minute when you speak to the CEO of onsemi, there are countervailing forces here. There are the secular argument, more chips per vehicle, more chips per industrial system, against what's going on last year and is still with us to an extent, which is we still have inventory overhang in certain areas.
I was just looking at that chart. Fascinating, Ian, that Europe was basically the only area that posted growth last year. We sit here as originally 3 Europeans, and it's kind of amazing that in their economic environment, they saw gains. Where, globally speaking, we're meant to see the rebound? Is it all about China getting slightly better?
I mean, it is in theory everywhere. You've had markets that were really quite poor, such as the PC and the smartphone. Now those markets have got through that inventory, and in theory, they're, with a bit of consumer demand and a bit of end market demand, they're going to be very strong. Broadly speaking, though, we're looking at AI, we're looking at the data center. The big concern still in people's minds is what's going on with industrial and what's going on with automotive. And again, you're going to be speaking to a CEO who will be able to tell you a little bit more about that in a minute.
Let's do just that. Ian King, brilliant to catch up with you. Thank you for bringing us the industry report. We appreciate it. Let's now deep dive into basically the highest performing chip stock of the day. It's up more than 8%, the best performer on the stocks at the moment. onsemi joining us, reporting fourth quarter results that, well, seem to post forward an idea that in this quarter gone, it was doing better than expected. And indeed, maybe, though, some of the forward-looking guidance not being as bad as had been expected. We're pleased to welcome Hassan El-Khoury, onsemi CEO. And Hassan, when we're digging into some of the overall focus of your business, just where are you seeing particularly some of the optimism coming from the investor? Why are you managing to think that despite EVs, for example, being an area we're worried about, stagnation, you're still able to outperform in that area?
Yeah, good morning. Thanks again for having me. We reported a quarter. I think the reaction you see in the stock, I think it's all based on where the expectation has been and really what a lot of our peers have already reported. What differentiates on semi for the last, I would say, 4 to 6 quarters, we have been taken action to match and become more in line with what we see from an end demand, both in industrial and automotive. If you recall, in the third quarter earnings, I started talking about automotive softness, inventory digestion. That extended. Therefore, it was not a surprise to what we announced today. It was more of an expectation and really better than expected. But nevertheless, it was a softness that we as a company have been very disciplined in addressing to get us to weather through it much better than a lot of our peers.
Hassan, one criticism from Truist Securities this morning was that there wasn't anything said about the outlook, what happens next in those end markets. So you just said we rebalance to make sure our output matched demand on industrial and automotive. But going forward, what are you hearing from those end market leaders and CEOs about what they think demand for their industry will be in 24?
I think for us, the way we're managing 2024, we're not managing for a recovery, which if you take where we are today as a base, 2024 is going to be basically down in all end markets versus 2023, which was a good year in a lot of the markets. So industrial, automotive, and then the other end markets will remain soft. If the demand picks up in the second half, that's great. That's all tailwinds for us from fab utilization that impacts margin, profitability, and revenue. We'd rather be in this spot rather than prepare for a recovery that doesn't happen. Now you have a correction mid-year. We're taking, again, a much more disciplined approach, which worked very well for us in Q4 coming into Q1.
We used the case study of silicon carbide in the EV context, and Caroline quite rightly points out that we think there will be growth in 2024. It will just be slower growth, that growth is decelerating in global EV demand. Does your business reflect that?
I spoke about it earlier today where, the industry still projects a high number for EV growth in the 30 to 40. What I believe based on customer engagement and really based on some of the leading OEMs in the automotive industry, what they projected for their EV growth in 2024, we look at it more in the 20 to 30 growth. So for me, I more trust what we see, and that's what we're managing to. Still very heavy growth, because what we also projected in light of that market growth is we will grow our silicon carbide 2x the market. So at this point in time in 2024, we're pegged to end demand. Products are out, qualifications are there. We're designed in all the platforms that we need to be designed into. And right now, it is an end demand signal. We will still take share. We will still grow ahead of market at 2x. The question is, what will the market do through 2024?
And as you said in your call, electrification remains a content expansion opportunity for you as you 2x. So who are the customers that manage to outperform? Why have you managed to get the customers that are ramping production? Where in the world are they ramping production?
Bottom line, they've always been consistent. You only win when you have the best technology. We've been providing the best technology at a high power packaging. So both device, silicon carbide, and the package we put in it, the best technology out there as far as performance. That's why we've been winning. So we've been broadening our customer exposure to kind of reduce that lumpiness from too many focused customers. We have recognized revenue from over 600 customers in 2023. That will keep extending into 2024 as more of the European OEMs start ramping for us. So again, a very broad base of customer, very diversified regionally, from China to North America, and like I said, in Europe. That gives us a very good base to clearly grow from as we manage through the short-term lumpiness of EV adoption.
Hassan Al-Khoury, onsemi CEO, best performing stock on the SOX today. Very quickly, I want to check in on shares of Coinbase, down around 9%. At their session lows, down more than 10%, on track for the biggest decline since June of last year. But I've got to be honest with you, Caroline, got no idea what's going on or no idea why. There are no headlines on the terminal relating to the name. We're going to continue to dig in it and get the crypto team on that, but a big mover to the downside, and Coinbase off 9%. This is Bloomberg Technology. All right, time for Talking Tech. First up, Samsung Executive Chairman J.Y. Lee has been acquitted of stock manipulation charges, removing the threat of jail time that's loomed over one of Korea's most prominent business people for years, and lifting a weight off of the company as it struggles with a global downturn and some more competition from Apple in the smartphone space. And shares in Atos fell as much as 30% to a record low after the French IT company dropped plans to sell $777 million in equity rights. Atos said it's seeking a mediator to help renegotiate a financing with lenders. Plus, Yandex has striked a $5.2 billion deal to sell its Russian business. It's the highest value deal yet to exit Russia following the invasion of Ukraine. Negotiations took more than a year, and it allows the Netherlands-registered company to develop projects abroad after divesting Russian units that generated most of its revenue. Caro.
Some key companies to be watching. Meanwhile, look, we've got to keep an eye on what's coming up with Snap. Look, they're cutting 10% of their global workforce. That, as we know, the tech sector continues to see layoffs more broadly, but we'll also be anticipating the numbers coming from this particular business. They report, of course, and we're anticipating actually some recovery in revenue. But what is the cost of having to let go of so many staff? We'll dig into that in a moment. Shares had spiked a little bit on the news of this cost discipline, but now we're back sinking more than 4 percentage points on this particular social media name. We'll dig into Snap in a moment. This is Bloomberg Technology. It's going viral. Taylor Swift making history this weekend by winning her 4th album of the year. If that wasn't enough, the superstar announced a new album on its way April 19th, to the excitement of Swifties worldwide. But also, there were a fair few elephants in the room that night. One of them, from a tech perspective, Trevor Noah did address. Universal Music Group, of course, pulling its music catalog from TikTok, which includes like the very own Taylor Swift, Drake, not to mention, but many others. And Ed, I mean, this was a night of celebrating women. This was a night where we saw history being made. And what is the new, I mean, I'm pretty sure you're more of a Swiftian than I am. The Tortured Poets Department, you excited?
Yeah, I mean, it's astonishing because Swift goes in tied to that event with Sinatra, Paul Simon, Stevie Wonder, and then exceeds that record. And we're doing this and going viral because it's all everyone's talking about on social media, right? But you can't celebrate on TikTok because, simply put, you cannot use Taylor Swift songs on TikTok.
Yeah, and that continues to be an ongoing issue of basically the monetization of such incredible moves made by artists like this. But when we're consuming that, and maybe from TikTok's point of view, helping market it, how much does the money flow to the artists, to the labels? That's the key question.
When I was reading Lucas Shaw's newsletter about this, you realise they've been negotiating on this for years. So it's not a new thing, but there's been a flashpoint because the volume of eyeballs is not translating into dollars in the artist's pocket. That's the tension.
Interestingly, of course, Taylor Swift's own collaborator saying maybe UMG should have given a heads up to some of the artists before they did this. But anyway, we talk more broadly about the world of social media and indeed, well, how lawmakers are addressing it right now. Because across the aisle, we're actually seeing work being made for legislation that would place safeguards, in particular across artificial intelligence. And now this is about Taylor Swift too, because it, of course, involves deepfake videos, individuals such as Taylor Swift, and they're, of course, pornographic deepfake images that were circulating on social media late last month. Social network analysis company Graphica determined that the images of where they originated from was actually an online challenge to break safety measures designed to block people from generating lewd images with artificial intelligence. Margie Murphy has more. So just go into the detail of basically what's happening on certain parts of the internet where almost these weird challenges are erupting that don't just affect Taylor Swift.
Right, exactly. For a long time now, before the images of Taylor Swift emerged on X that caused huge outrage and caused X to block Taylor Swift searches for a while, these deepfake pornographic images of several women, celebrities, politicians were already appearing on a 4chan forum and on a thread where a community was engaging in daily competitions to try and break the kind of text-to-image generation models that we're all really familiar with, like Microsoft's image designer, OpenAI's DALL-E. And they have, for weeks now, been trying to teach each other how to use certain words to get around the safeguards that have been put in place to create these pornographic images that these companies who create the models say aren't allowed.
The technology story is the use of text-to-image creators, and the policy point was the banning of some keywords and then using others to get around it. Then there's the political side of this story, which is basically this has been a really big story, and now lawmakers in Capitol Hill are thinking about what they need to do about it.
Right. So Taylor Swift was not the first person to be deepfaked. She won't be the last. But because of her celebrity, late last month, people were talking about it so much more. We had the White House condemning it. We had this re-energization of a bill that had been brought in, a bipartisan bill. Because at the moment, there is no federal law that bans deepfake pornography, and we've got this kind of scattered approach across states. So although this has been happening for a really, really long time, we're finally seeing the kind of politicians, lawmakers, everyone's taking action, and rightly so.
All right, Bloomberg's Margie Murphy, who, by the way, has done a very big body of reporting on this issue. I highly recommend you read it on Bloomberg.com. Another story, Meta's independent oversight board agreed with the company's recent decision to leave up a misleading video of US President Joe Biden, but called its policies on AI-generated content incoherent and too narrow. The board is now urging Meta to update its policies ahead of the 2024 US general election. We'll continue to follow, of course, that story throughout the year. Karen.
Yeah, and let's just stick on the world of social media, because we've got to shine a light on what's happening with Snap, the parent of Snapchat, cutting its workforce by around 10% worldwide. Joining us, of course, around the entire focus of a slate of technology companies that have announced layoff after layoff is Mandeep Singh of Bloomberg Intelligence. And really, this is once again a company perhaps trying to front-run a slowing ad market narrative that's going to come from the earnings with, look, cost discipline, we're doing something about it.
Yeah, I mean, look, Meta has set up a good blueprint in terms of what companies need to do, especially in the social media land, and it's worked for them. I mean, the proof is in the numbers they delivered last week, and every company that went big in terms of layoffs in 2023 actually benefited with better execution and top-line growth in the case of Meta. I would be curious to see how ad pricing tends recover for Snap, because what we saw with Meta was there was a clear inflection in terms of digital ad pricing coming back that actually helped their top line. And I would be surprised if it's exclusive to Meta, because we know from the past that all these digital ad vendors benefit when, there's a cyclical uptrend. And so that is, to me, the key number for Pinterest and Meta is they should also see that lift in ad pricing when they report earnings.
What's interesting about Snap, though, is that they've kind of been flailing to find some sort of diversification. They were looking into augmented reality, helping other companies embrace that, and then realized that wasn't the way they should be spending their money. How are you seeing their narrative build as to what this company stands for, where the growth is going to come from?
I mean, they probably are narrowing their focus. So the layoffs have to come from somewhere, and the last round of layoffs layoffs was really focused on augmented reality because they wanted to narrow down the focus to the profitable part of the business, which is the social media ads. Look, with Meta, we saw Reels engagement continues to grow, 25% growth in Reels. Snap has an equivalent of Reels. It's called Spotlight. They don't make any money off of that. And that's where you want to see monetization. Why is Meta monetizing video and they have caught up to TikTok and not Snap? And I think that's where the story is still missing. Why can't Snap monetize videos as effectively as Meta?
This sets us up nicely because Snap reports earnings after the bell tomorrow. And I think my takeaway from the Meta earnings was I understand how your work in AI is relating to your core business. You point out Snap has Spotlight, but it also has Snapchat Plus, My AI, and I don't really understand how that's helping them yet.
Yeah, I mean, look, when a company of this size, Meta is like 1.2 trillion, compare that to Snap, 27 billion. So it's already 50 times in a market size compared to Snapchat. So I would much rather bet on a smaller company at this point of time to drive up its engagement, and it should have a long runway compared to Meta, which we know is executing flawlessly. It's got that AI scale and its own Llama model. But still, for a smaller company with 400 million daily active users, they should be able to figure out how to use AI to drive their engagement, how to improve their ad infrastructure. And that's where I do think Snap things are fixable. It's just we haven't seen that monetization aspect yet from their ancillary products.
At the end of last year, Mandeep, you and the team also wrote about Snap's kind of e-commerce potential. I think that was because it had done some partnerships with Amazon, for example. Do you believe that's an opportunity for Snap still?
I think so. And look, Meta has also done a partnership with Amazon, so Snap's partnership as an exclusive Pinterest has done the same. For all these social media companies, the holy grail is in-app e-commerce. They haven't figured it out because the logistics part is very hard when it comes to social media pivoting to e-commerce, and we have seen that with the Chinese companies. But in the end, Amazon partnership does make sense because Amazon clearly has the fulfillment capacity, and it does need the channel for the social media companies to transfer over the customers that are engaging with them almost 60 to 70 minutes a day. So it does make sense, but it would be interesting to see how it affects Snap's gross margin.
Well, we wait for those numbers to be coming out, of course, and really dictating how this stock continues to perform. Mandeep Singh and Bloomberg Intelligence, brilliant to get the deep dive ahead of Snap's own earnings. Meanwhile, coming up, we'll be turning back to the state of the semiconductor industry. We're going to be speaking with the Element Solutions CEO, Ben Glitchik. This is Bloomberg Technology.
We established ourselves as, a key AI contender.
India, Japan, France, Canada now, Southeast Asia, Singapore, speak up about the importance of investing in sovereign AI capabilities.
The early signs of Gen AI use cases are actually exciting.
We're going to show just how capable and how much AI is now part of really the entire AMD story.
For the very first time, because of generative AI, computer technology is going to impact literally every single industry in every single country.
That could create an interesting opportunity for upgrade cycle in phones.
What an array of CEOs after, of course, earnings from the chip makers. And they all had a lot to say about artificial intelligence, of course, in this quarter and beyond. But let's check in on the markets right here, right now, when it comes to semiconductors, because we're managing, despite the macro picture of which is one of too strong a growth from a US economy, so therefore pushing back on some of these tech stocks. The stocks does remain higher, up by 0.3%. Largely, we've got NVIDIA to thank. We thank Goldman Sachs for that particular re-rating on this particular price target for NVIDIA. They see yet further growth. Interestingly, AMD is on the downside, even though they too had an upgrade coming from Philips Securities, in fact, about AI tailwinds, but it's under pressure more broadly as the rest of the market feels a little bit of weakness amid this stronger macro data. But Ed, it's notable that on semi manages to be riding high on its earnings. We've got a deep dive continuing on chips.
Yeah, someone that knows the space well. Ben Glickish is the CEO of Element Solutions, which produces chemicals in almost every EV, smartphone, computer, and develops next-gen chemicals that enable tech advancements. And what all of those things have in common, we focus so much on this show on the GPU, CPU, analog level, but we're talking about circuit boards, integrated circuits, and what they all have in common, Ben, is they're all rethinking their supply chain. And we're heading towards this kind of decoupling from China. We've done a lot of reporting here at Bloomberg about Apple, for example, wanting to shift some of its supply chain base from China to India. Is that, as somebody involved in that supply chain, as simple as that?
So we like to say chips don't float. And so Element Solutions products are used in semiconductor manufacturing, in assembling, putting chips onto circuit boards, and in making high-performance printed circuit boards. And the printed circuit board market is primarily an Asian market. But we're seeing a shift towards something called China Plus One. And so supply chains are moving outside of China to places like India, Vietnam, Thailand, Malaysia. And we're even starting to see some greenfield investment in printed circuit board capacity here in North America, Mexico, and the US.
Ben, when it comes to your role and Element Solutions, how much are you part of the solve for these companies?
So our technologies are used in every high-performance electronics device in the market. So we're an enabling provider of chemical technology for all of these markets. And for us, our manufacturing processes are pretty simple. Our people are global. And so we're welcoming these supply chains as they move to new places. Our footprint is already there. And it's an opportunity for us to support our customers as they diversify their supply chains when they move out of China or into new markets.
And what, therefore, for you is any sort of block on your own ability to keep up with the demand? All we hear about is just like the absolute scale, the price point, the need. Has there anything that's been slowing you down, or is it just ability to roll out in lockstep with the demand?
Yeah, so we're fortunate because we've been in these markets for decades, and our customers and our customers' customers, the OEMs, rely on us to come up with new solutions to enable their next generation products. And so for us, staying on top of innovation, doing technology roadmap exchanges with customers, enables us to meet those emerging needs. And then we make investments in new material science technologies as the legacy capabilities don't meet the needs of next generation chips for AI. We're investing to support that outside of our four walls and bringing very interesting capabilities to market.
Ben, when we think about some of the end markets that we listed at the top of the segment that you're in, EV, smartphone, there are mixed forecasts of what 2024 looks like. You heard from Cristiano Amon a moment ago, right? Qualcomm's saying flat to low single digits growth in the smartphone market. We've covered a lot broadly, a slowdown in EV growth globally. Is that reflecting what your customers are engaging with you on?
Yeah, so we called a bottom in our electronics business in the second quarter of 2023. 2023 was a tough year in electronics, not just from a demand perspective, but also because there's a lot of inventory in the channel that had to clear. We've seen a recovery in the back half of 2023, and we see growth in 2024. Smartphone units should grow in 2024, and we'll be lapping a period of inventory clearing, so we should have nice growth from that part of the business. And our business isn't just driven by units, it's driven by content per unit. So each next generation technology of smartphone has more value of our technology because it's enabling higher performance applications. Similar in the EV market, where we've got game-changing technology in power electronics, and that market's been very strong for us. We're seeing customers adapt our technology to deliver better performance vehicles. So even if the EV market is flattish, we're going to see real growth for our capabilities in electric vehicles because of the technology trend shift.
Ben, I want to go back to the supply chain. Is India ready to be a greater contributor to supply chains for consumer electronics, the semiconductor industry, and AI?
So there's definitely a significant investment in infrastructure that's required in India, and we're actually seeing that. Huge investment from many OEMs and partners and supply chains to support it. In fact, we've been asked by one of the largest smartphone OEMs in the world to help train the Indian supply chain to meet their needs. So it's a great
Who's that?
We don't speak about our specific customers and supply chains broadly or in public, but a very large smartphone manufacturer is asking us to help train the supply chain to bring them up from a capability perspective to enable their production.
Well, we want to thank you for being here in town, ringing the bell. 5 years, I think, was the celebration of today of Element Solutions. Ben Glicklich, we thank you for your time.
For video game fans, the name Blizzard Entertainment was once synonymous with perfection. The maker of StarCraft, Overwatch, and World of Warcraft forever changed the video game landscape. But then, its corporate parent Activision started cracking down on Blizzard's proud autonomy. It's all chronicled in a new book, Play Nice, The Rise, Fall, and Future of Blizzard Entertainment, and it's authored by Bloomberg News' Jason Schreier, who joins us now. Jason's congratulations. I mean, some of those titles, Diablo 4 in particular, in more recent history, the fastest selling title. And then there's the company story of everything that happened in the last 12 months. How'd you write a book about it?
Yeah, man, I've been frantically rewriting the ending over the last couple of weeks. Yeah, it's quite a story. It's a 33-year history that I'm chronicling in this book, starting with 2 UCLA students who set out to start a video game company and wound up building an empire that became thousands of people, billions of dollars, and many, many millions of fans.
Jason, you've written a couple of best-selling books, so I'm interested as to what sort of reception you tend to get to these books. Who are the audience that really gravitate towards these sort of journeys, these stories? Is it ever an introduction to those that don't know that much about the gaming industry?
Yeah, it's funny. My first 2 books were kind of where there were anthologies, including a bunch of stories. So a lot of people could kind of glom onto them and find an interesting story, a company that they had heard of or a game that they played. But I also tried to make them appeal to the mainstream. And with this one, I've tried even harder to make it something that my mom would read. My mom hasn't read my first 2 books, but hopefully she'll read this one. Yes, I think there are a lot of gamers out there who will want to read this book, who will find it interesting, who will get a lot out of the behind-the-scenes details and the creative struggles and the development stories and the games and just knowing the story behind World of Warcraft and Overwatch and Hearthstone. But I also think that it'll be really interesting to anyone who is interested in kind of behind-the-scenes corporate stories like The Social Network, stories like Bad Blood, stories that are about companies that grow and their cultures and how they evolve and the kind of the trials and tribulations along the way.
And the story keeps going behind the scenes because the latest is Joanna Faries, who ran the Call of Duty business, is now taking the helm at Blizzard, I think I'm right in saying. Did you keep up with that?
Yes, my editor is waiting for me to send over a revised version of the ending. Yeah, I'm spending the next couple of weeks kind of revising the ending, changing a few things. And yes, unfortunately, there was a mass layoff and a game cancellation just a couple of weeks ago, kind of a tragic way for the new era of the company under Microsoft to begin. Microsoft, of course, purchased them for $69 billion in a deal that closed in October. And one of Microsoft's first moves was to slash a bunch of jobs. So yes, I will be incorporating that into the manuscript. But at a certain point, yes, this book has to end, and it'll include up through just about the present day.
Sequel, Jason Schreier, we thank you so much for spending some time with us. And congratulations on the never-ending book. It's going to be a great read. Meanwhile, that does it for this edition of Bloomberg Technology.
Check out the pod. That's where you can find it. This is Bloomberg Technology.